Welcome to TradeTheMBI.com. This is John's reports for the 26th of May. It was a nice holiday weekend. Got a little sun, was able to get out and about. Are things back to normal? No, you get this new norm of, everyone wearing masks and the limited scale of the openings as I'm seeing it here in Italy, I think is going to be reflective of what's going to go on elsewhere. It's just a dramatically reduced both capacity as well as demand, and I think that's just going to pose problems. But we're looking at the ES here breaking 3,000, just like I talked about. And again, this suggests that there are, the other factors, not just the Fed backstop, but like I said, the amount of money that's being applied to it is going to create a devaluation or hyperinflation condition at some point. And the market has to factor that in. And the only way to do so is to increase the multiple as it appears now, but in time, that devaluation really makes things status quo. So there you have it, a status quo press of the market higher. And the NASDAQ, of course, reaching, literally we are just like very close to the all-time highs within a record-breaking depression. No other way to describe what it is. Again, from a Euro standpoint, the fact that the European Union is theoretically open for business and doing things is creating this, stark improvement. Now, when you think about it, the funny thing is here in Italy, they had fewer than 100 deaths across the entire country of, 60 million people. We never really saw anything happen here in Florence, so it's just an interesting dystopia. I don't even know other way to describe the situation. From an oil standpoint, though, the resurgence or even the limited opening is going to provide enough of a backstop, hopefully, to keep oil, at least the consumption of it, to a point where you're not getting these massive excesses, because it's going to be months before that backlog, even if you just immediately turned everybody back onto work. That backlog, but that's going to continue to build, and I think people are going to hold out for higher price, which means that we could see a continuation of that price build, which will add some inflationary pressures. No question about it. And of course, gold, we expect it to break past these ranges significantly. It's not going to hold within this range because there's no question that it's going to be sought after. The holiday session was straight up, and then we broke out here into the pre-market as well. It just creates a new series of positive extremes and kind of mark those with the two little levels right there that are likely to see some serious action right back down at the 29.90, 29.63. Will it happen anytime soon? We just got to go with what is, and what is right now is just a continuation of smooth liquidity being applied. They're talking about how institutional investors are this, that, and the other, but at the end of the day, the biggest institutional investor and the only one that really matters is the Fed, and they've been buying up everything. So just don't fight the Fed. That's all I have to say. It's a simple one. There's nothing complicated about it. Does it give us a distortion in our algos? Not so much. I recognize the same situation back in 2010-11 when the Fed was taking additional steps, and really what you ended up with is more situations where you have these extended runs of cyan below red, just indicating there just wasn't enough selling pressure. And when you did get DOC spreads, they usually came with full resets of short-term buyers, meaning it was just an unlimited amount of money available to them to just continue to press things. And then you still have to take some of the short signals, because at some point what they do is they just let it fall back down under its own weight and see how much selling pressure there is and what it's going to take to continue things. But in this particular case where zero rates, they're not really worried about deficit, because you can kind of borrow forever if you don't have any interest associated with the borrowing. So that's kind of the incentive at this particular point. You can add $10 trillion, and if you're not paying any interest on it, you really don't care. You figure at some point you're going to regain some fraction of it. I guess theoretically, though they haven't really shown any proof that the governments are able to actually maintain a surplus or actually reduce debt. But you can certainly reduce debt by increasing inflation significantly. That is the answer. It happened in the 70s, a little bit in the 80s. It takes care of everything. So we'll see if that's the general play. The market's sort of indicating that that's what it is, because the value that we're at here, 3009, given where the economies are, just from a 6-month period ago, what you're looking at is a massive restructuring of what value is. So that's the long and the short of it for now. As always, though, now that we've had our brief little holiday, we can get back to some serious action and prepare for the summer months and the interesting dynamic of what this reopen broadly is going to mean and how it starts to relate to election coverage, and that's starting to build. That's going to be the next factor coming into this one. And of course, everyone's going to be watching whether escalation between China and the U.S. From a trade war as well as a war of words about who's to blame and the recriminations when all that starts. So this is going to be quite a PR game going back and forth, and that's going to have, I think, some significant impact to the market. As far as the psychology goes, it's not going to stop the backstopping by the Fed, but as I said, those are going to be just key points that are going to be selected. We're going to see them a lot within positive extremes and or negative extremes, the dip below the red line down below here when we get the magenta candles on the extreme histogram. As always, though, trade well. We'll talk again later.